Saurabh Mukherjea, Founder and Chief Investment Officer of Marcellus Investment, joins in. Saurabh, hi, thank you very much for joining us. Net, good budget, bad budget. Are you disappointed with tinkering of capital gains? Or are you impressed that fiscal discipline has been maintained more than what we were expecting?
I think the FM ticked all the boxes I could have expected of her. I think she needed to take on this kind of froth that was building up in the market. RBI and SEBI have been very clear that they're seeing too much money come into the stock market, too little going into the real economy. All credit to the FM for jacking up short-term capital gains to 20%. Secondly, she took on the employment challenge, the challenge of creating millions of jobs. She took it on head on. I saw 5 measures being announced to juice up employment. Even if 2 or 3 of those work, I think that's a meaningful step up. And thirdly, rural India has been suffering since COVID. I think there was a big allocation towards rural India as well. To fund all of this, obviously, capex had to be throttled off. So I don't think there was any increase in capex related to the February budget, which I think is also sensible. I think government capex has already gone up by 30% each year for the last 3 years. There wasn't obvious need to jack up capex. There was plenty of need to jack up RevX and boost consumption, and she's done that. So full marks to the FM. I think remarkably well thought through, common sense oriented budget.
Well, it was a well-balanced budget, and while most people were worried that it would be have some shades of populism, that didn't actually happen. Madhusudhan Kela, now founder of MK Ventures, now joins in. Hi, Mr. Kela, it's Samina joining in. First up, quick take on what did you make of this budget? There was tinkering on capital gains, but we've been expecting that now for a few years. Markets have also so far taken that in their stride. Or at the same time, it's not been a populist budget. It's focused on agri, it's focused on employment, a 5-year budget in every sense of the word.
Yeah. I mean, I would say the overall, it's quite a good budget. It really focuses on a lot of long pending issues like employment generation, the deep reforms which are needed in agriculture sector, the overhauling and making changes in long pending income tax laws, and really creating, opportunities for youth in on the whole. So, and at the same time, on the face of it, when you look at the number in the budget speech, they looked very large, and it looked like quite a populist budget. But when you go into finer details, I think they've done a commendable job of sticking to fiscal discipline, of not only sticking, but basically lowering down the fiscal discipline, the fiscal deficit, also ensuring that the government borrowing over a longer period of time, as a percentage of the GDP, will go down, which will argue very well for our long-term rating. So on the whole, it's quite a good budget. Coming down to markets, of course, markets have had a very fabulous run in the last 3 years, and more specifically in the last 6-9 months. The market had some reason for small corrections here and there, and that came in the form of short-term capital gains and also some increase in long-term capital gains. Also, it was, you say that it was expected, but I was certainly not expecting it in this year at least, because the government fiscal situation going into the budget was really, really good. However, I think they have taken a larger call of ensuring that the money really goes into the real economy and doesn't go all in the stock market, and which is why they have actually brought down all the asset classes and categorized at 12.5% long-term capital gains, so that people can invest into other asset classes as well. And so they have made it as attractive as the equity is. And the second point is also they have lowered down the duty on the gold, so that some amount of investment can even go into the gold. So I think those measures, coupled with this long-term and short-term capital gains tax, it basically indicates the government intention to ensure that the saving must get distributed and not go only into an asset class. So on the whole, I'd say it doesn't really, it argues very, very well for the long-term growth of the country, and it doesn't change my stance on the stock market from a medium to long-term perspective.
Absolutely. Thank you, Mr. Kela, for that. stay with us. Let me quickly move to Saurabh. Saurabh, this is Harsh here. Saurabh, has enough been done to kickstart the corporate capex cycle? Because that was one piece where the market really had their eyes out on where the budget is concerned.
I mean, look, corporate capex, I don't think the government can do a lot more than they've done. The main thing I thought they did was by making it unattractive to do buybacks. I think the FM is very clear. If you now announce a buyback, you'll actually be taxed not just on the amount or not just on the capital gains, but the investor will get taxed on the entire payout. I think that'll put pay to any corporate buybacks this point in. And since dividends were already taxed, the incentives are now there for companies to spend the money on capex rather than dividending it or blowing it on buybacks. And in parallel, by keeping the budget deficit under control, by pulling back the government's borrowing, the government has reduced crowding out. The 10-year bond yield should be coming down. Interest rates are likely to come down in the next few months. So the government has done everything possible from a fiscal standpoint for private sector capex. Ultimately, it's a free market economy, and it's up to our promoters and our industrialists to do the needful. I don't think that in a free market economy the government can be expected to do more than what was already done in this budget.
Okay, I take your point. Mr. Kela, both from a private sector capex perspective as well as from a personal tax perspective, do you believe enough has been done to spur consumer spending as well as private capex spending?
There is never enough, you can say it is being done. But I think whatever they could do, they have done. Ultimately, we have to also understand they are also operating within the constraints. Like budget is nothing else but a balancing of income and expenditure. So whatever is your income is what you can spend, making sure that your fiscal deficit doesn't go beyond a point. So I think adequate is being done. They have addressed quite a few issues which were really pending in terms of economy, the biggest being the job creation and the opportunities which are being created. It's such an innovative scheme actually. 500 companies will hire internship and that will go into the CSR budget. That will really encourage a lot of companies to hire younger people and provide employment, which is actually absolutely the need of the hour. So in a way, I would say a lot is being done, and now it is left to investors and entrepreneurs to take the risk and do their ventures. Right? What can the government do beyond a point?
Right, Madhu, and you're smiling away, which makes me really believe that you're genuinely impressed by this budget. But if job creation is the focus for the next 5 to 10 years, and as an equity market participant, how would you play this employment boom? Would it be consumer stocks? Would it be auto stocks? Where would your bias lie if you're looking at investing in this market for the next 2 to 3 years?
I mean, I will not go one-on-one to honestly to look into opportunities because of A move or B move. The reason why I'm smiling is because it is business as usual for us, right? We are back to, because, before the budget, there are lots of rumors which go on, this FNO will get this taxation, that taxation. There are a lot of things which go around the budget. Once the budget is passed, at least you know that it is life as usual. So I would say that it is back to really going to the drawing board and really being able to identify bottom-up opportunities which will arise from various sectors. At this point of time, I can't thumb the table and say that I will buy a particular sector or B particular sector. I will look for bottom-up opportunities. Within the sector, I will keep a 3 to 5 year horizon, and I will keep my return expectation as moderate, considering the fact that last 3 years we have made really extraordinary money. That the focus would also be to ensure that we don't extrapolate that kind of returns in our mind and make sure that we are investing with moderate return expectation and not what we have gained in the last 3-4 years.
Right. Saurabh, you want to comment on that as well? We've borrowed returns from the future, and that's a given with the kind of rally these markets have seen. It's a raging bull run, to say the least. There is a sense and quarters of the market, people like you do believe these are expensive markets and a correction is much overdue and maybe also healthy for the markets. Earnings have come our way, most of them have at best met street expectations. Do you feel now is a good time to take some money off the table and then probably, come back with different vigor, but just wait it out for now, exit, take profits off, and then reinstate or reinvest those funds at a later stage?
Actually, it's a very interesting market. If you look at high quality companies, they actually haven't run up. So we're large investors in HDFC Bank, Asian Paints, and both stocks I think have given close to nil returns. Even companies, high quality companies which have done reasonably well, say a Titan or a Divi's Lab or a Dr. Lal Path Labs, they've had reasonable runs. I don't think there's been a blockbuster bull run in a Titan or a Divi's Lab or a Dr. Lal Path Labs. Where you've seen crazy rallies, utterly unjustified rallies, in my view, is a whole bunch of PSU-related names, a whole bunch of power and infrastructure names, and there's clearly, those valuations are sort of from different planets. So there's two parts to the market. If you strip out the low-quality rally, if you strip out the rally in low-quality stocks, the Indian market actually is quite attractively valued. As I'm sure everybody watching knows, the HDFC Bank is trading at a 20-year low on PE multiples. Asian Paints is trading at its long-term PE multiple. So I think it's a good place to be. It's a good time to be buying quality. As I'm sure everybody also knows, we are invested in it through our PMS. I, as an individual, my parents, several thousand of our clients. And that's my point that I make to global investors as well. Strip out from India the low-quality stocks rally, and the Indian market is not expensive. The economy is in good shape. Take a long-term view on India, put money in India, put money in great Indian companies, and it will be in great shape for many years to come.
Saurabh, we'd have loved to chat with you longer, but I guess we'll have to wrap up on that note. We'll hopefully see you soon.